One of the theories a lot of great investors have right now is that deflation is a much bigger risk than inflation. I tend to agree with them. And tariffs, deportations, AI, robotics, all this stuff is very deflationary. Jeff was talking about this idea of if there is deflation, then there may not be the debasement trade and all these things that people have been talking about. So maybe you want to describe a little bit as to kind of your current viewpoint on there's this deflationary pressure, but what does that mean for the dollar or for asset prices?
Yeah, I think what happens a lot of times is people create a narrative and then go looking for ways to support it. What I do is try to look at the markets in particular, never focus on one market or another, and see what they're telling me, and then try as best as we can to construct a narrative about what the markets are saying. So start with something like the yield curve. The yield curve has been bull steepening since September of 2024. Bull steepening is a very negative deflationary signal. Let's define our terms here, because you and I were talking about this, and I know a lot of people don't realize there's two different forms of what is called deflation. One of them is very good, one that we really want to see, and the hope for AI is it creates this productive disinflation. We all know what productive disinflation is. When we were younger, we know what it is intuitively. When we were younger, you bought a fancy computer, it was really, really expensive. But over time, it gets cheaper and cheaper and cheaper. That's not harmful deflation. That's free market capitalism doing what it does well. That's not what the markets are saying. What the markets are saying is that the economic situation is getting worse, not better, and therefore it's going to lead to market volatility at the very least. It's going to lead to economic volatility, which, by the way, you've already seen. We had no job growth last year. An entire friggin' year without no job growth is going to have downstream consequences. So what the markets are saying is that balance of probability, we're going to see interest rates go down and stay there for a pretty long time, which is not an inflationary situation. It's the opposite situation. And the counter argument to that is that in a situation like that, that's going to unleash the money printing machine of the government. The discussion that we were having is that the government doesn't actually have a money printer. Money comes from the banking system. And if the banking system is not in the mood to create money, it won't. It won't matter what the Fed does. It won't matter what the federal government does. If the banks don't create money, there won't be money. And it's really not about supply. It's about circulation, which is why we watch these signals like the yield curve. So last year, for example, when everybody was talking about tariff inflation, sell America, treasury rejection, the treasury market itself was saying, I don't see any of those things. Yield curve kept bull steepening, which said there is no tariff inflation. We have a bigger problem on the employment side for macroeconomic reasons, not for AI, and that the outcome of that is going to be something that looks like a recession for too many people if it doesn't actually become an outright recession itself. So in that situation, very different set of outcomes than dollar debasement, inflation, and everything. So you start the treasury yield curve and look at other assets like gold. If you're looking at strictly gold goes parabolic, you think, well, there's dollar debasement. But gold can go up for other reasons. So you take gold and balance it against the treasury yield curve. Treasury yield curve says no dollar debasement, no deflation. What is gold saying? Gold tends to go up during periods when people want to own a safe haven. A safe haven demand looks a lot like what the treasury yield curve says. If you're in China, for example, and we go through a deflationary period, as I just described it, macroeconomic downturn, you're not going to want to own, you want assets. They don't care about Jay Powell or Federal Reserve interest rates or the dollar. They're saying, do I want to invest in something in China? Hell no, I'm going to own gold. So gold as a signal wasn't about dollar debasement, it was about safe haven. That fits with the treasury market. And it fits with a whole bunch of other markets as well.
When you think through that, you mentioned gold. What about stocks?
Stocks, volatility now.
Volatility up or down?
Both directions.
Both directions.
Both directions. So there's an anxiety that maybe there's something to the macroeconomic case that maybe AI won't be able to overcome with all of its positives. And believe me, I'm long-run positive on AI for the reasons that we discussed. So you got market volatility in the stock market that is consistent with safe haven demand, treasury yield curve, bull steepening. You start to pull in all of these various signals that are coalescing on what we hope is an accurate narrative, but a common narrative, which is more of a recessionary downturn type of environment. And then you get the macroeconomic data that suggests, yeah, that's the case, at least for enough of the population that it becomes a major issue. Again, zero job growth for an entire year. That is an unhealthy economy. And you don't just gloss over that. An unhealthy economy that gets more and more unhealthy. And I imagine most of the people watching me are saying the same thing. Yes, this is an unhealthy economy. This is a sick situation. So the markets are saying, yes, we hear you. Not only do we hear you, we're betting on the consequences of that unhealthy economy.
What are you saying, though? Because right now, you got the story that also came out yesterday. U.S. debt set to crush World War II record. I'm sure you saw that.
Yep.
as annual deficit explode to $3 trillion within decade.
Right.
So where are you going with this?
What I'm saying is,
are you saying there could be a possible market correction?
Which market are you talking about? Stock market?
Yes.
Let's start with the deficit. The deficit, under these types of conditions, the marketplace, the general financial marketplace, wants to own that debt because it is most liquid. Traditionally, bond markets, government bond markets, for a variety of reasons, and none of them are actually really good, they are the most liquid asset. So in a downturn, safe haven, you want to own U.S. Treasuries, regardless of the amount of Treasuries that are printed. We saw this during the New Deal, heard the same arguments back then. FDR is going to bankrupt the country, it's going to explode the dollar, which actually did. Treasury market, interest rates are going to go double digits. They actually did the other thing. During the 1930s, Treasury yields fell. They stayed down the entire decade because of demand for safety and liquidity, what's perceived to be safety and liquidity. So if you see the U.S. government go absolutely ape shit, issuing debt, pardon my language, I think it's appropriate here. We all agree that deficits are unsustainable, or deficits are a major issue. It's not an issue for the Treasury market. And the reason why it's not an issue for the Treasury market is because of this perceived demand for safety, which is the other side of gold and some other things.
So
that is a huge signal.
Is it problematic for the rest of the world if the U.S. isn't issuing all that debt, though? Because
yeah, that's actually we don't have enough Treasuries. I know that's going to
meaning there's not enough deficit spending.
It's not the deficit spending; it's the financial instruments that are at the end of it.
Isn't that what creates the Treasuries? Though, is the deficit spending?
Right. It's a perverse situation where we actually need the government to spend to create Treasuries in order to satiate the market demand for it.
Pump.
That's trippy.
We come at it from different ways,
horrible.
but I think we agree in that. I do believe people are drastically underestimating the risk of deflation. I look at trueflation over the CPI metrics. Trueflation is showing under 2% every single day this year. So we are right now. This morning they were at like 0.8 or so. And so what I believe is going to happen is they are going to actually want the government to print more money, right? And we disagree a little bit in terms of how that happens. But if you have a deflationary pressure like this, we have been trained for the last 15 years. If the government prints money, you get inflation. But if you have tariffs, you have the deportations, you have the AI, you have the robotics, the government could actually go and try to stimulate the economy, bring down interest rates, print money, and you can still have that deflationary pressure. And so I keep calling it like a monetary slingshot, which is in the short term, I actually think there's a number of assets that are going to have some sort of headwind to them. So you may get that volatility in the stock market. Bitcoin's obviously down. Gold has kind of come off of the highs. But if they are going to go and do this kind of to address the deflation, over the long run, they're going to destroy the currency. And if they do that, then you're going to want to own these assets over the long run. So whether you're buying Pokemon cards, right, or you're buying, in my case, Bitcoin, gold, whatever, I think that you're going to do very well over the long run. And so what scares me is when people try to trade this stuff on a day-to-day basis, because of the volatility, because of the announcements, because of the geopolitical differences on a day-to-day basis, it's just very hard. And so it's more so just what is in your portfolio for the next 10 years to benefit from something like this. And I think it's going to end up being those scarce kind of hard assets.
I think equities is, if you're too careful to try to time, we've all seen the chart of if you were you try to time the market and you were out for a period, it goes from 12.4% over last 8 years to, 9.1%. If you're out 20 of the days, you're at 6%. And how important it is to be there on the big days, when big days happen, and be able to tolerate the bad days. But if you go away from equities long term, if you're somebody that's not professionals that do this on a daily basis, it's problematic if you try to time it right now. And I do talk to certain people. I remember when COVID happened, one of my executives took out all their money out of equities when it hit 18,000. Remember when Dow hit 18,000? Everything out of equities. They lost $3 million, took it out of equities, came back in equities, at what? At 33,000. You know what it is to lose that 18 to 33,000? You're not going to get that back again. And these guys were they were older. They were not younger. It's not like it was somebody that's 48 years old that could afford it. This was somebody that was a little bit older, closer to retirement, that did something like this. We have our annual sales leadership summit that is coming up this year. We're doing it at the Trump Doral. I went to the property the other day. Unbelievably beautiful property. And if you're a sales person or a sales leader or a CEO that wants to drive sales and find superstars and develop superstars, Rob, play that clip that you have. I think Alicia sent it to you. Go right ahead, buddy.
I got a question for you. Which of these two skill sets guarantee success more? You being able to recruit rock stars, 8s and 9s, coming in talented and they change the company overnight. Or 2, you knowing how to develop rock stars. Which of these 2 guarantees success? From my experience, when I was not a rock star and I got lucky and I recruited a rock star, I could never keep the rock star. Eventually, I obsessed over developing people to succeed in sales. Once I did that, all the rock stars started knocking on the doors because they wanted to work with me. This is why once a year I host an event called the Sales Leadership Summit. This year we're doing it March 25th through the 27th at Trump Doral. If you want to find out how you and your team can attend this event to learn how to become better sales leaders, click on a link below, fill out your information. One of our consultants will get a hold of you.
There you go, Rob. That's the QR code, and we're going to put the link below. Rob, if you can put the link below as well for people to go learn more about it and fill out the information. One of our representatives will call you and answer any questions you may have about the event, and hopefully we'll see you there March 25th to the 27th at the Trump Doral.
If you enjoyed this video, you want to watch more videos like this, click here. And if you want to watch the entire podcast, click here.